Welcome to today's episode of Mangomonkey Learns Money, where I discuss personal finance, investing, and how to become a millionaire. Every Sunday, I analyze a particular stock on the Australian Stock Exchange, and today I will be talking about the Temple Webster Group Limited. Ticker code is TPW. This stock review was requested by one of my friends. I never actually heard about this company before, so I spent a couple of hours just to find out what they are, what they do, and I did this by exploring the internet using Google and a few other websites. I went into CommSec, I went into the Hot Copper website, and also I watched YouTube videos. These days you can actually get a lot of investing tips and company analysis from YouTube. So yeah, this is not a financial advice, this is a YouTuber talking about a particular stock on the stock exchange based on what he sees on YouTube. Never trust a guy on YouTube. There is a reason why a financial advisor charges thousands of dollars for you to invest with them. Now that I have made my disclaimer, Temple Webster Group is basically an online furniture company. The main difference with them compared to other furniture stores is that they do drop shipping. They also have an iPhone app as well. I will start this video by telling you what I typically do if I want to very quickly research a particular company. I would go into CommSec, find the company, look at the 1-year chart and then the 3-year chart. For Temple Webster, you will be able to see that the chart in the last year basically looks like a rocket launching into outer space. The 3-year chart also looks similar. After I look at the chart, I will try to find a few basic statistics about the company. I normally look at the PE ratio, which is the price of the share, divided by the earnings per share. And I look at the market capitalization of the company, which is basically the share market valuation of the company. So for TPW, the PE ratio is around 100 and the market capitalization is around $1.6 billion. On the desktop version of CommSec, you will see this from the quote screen within the summary tab. All the way down of the summary tab, you'll see a snapshot section, and that's going to give you the key snapshots of the company. You can click View Financials to find out more details about the financial statements. If you use the mobile app, it's on the Details tab of the company screen. Now for me to buy into a company, usually I want the market capitalization to be at least 100 million. It's better if it is $1 billion. This is because I want to make sure the company is not too small and has had a chance to prove itself. If the market cap is large, the company will also be more liquid, so if I want to sell my shares, it's less likely that I will need to discount my selling price in order to get rid of my stocks. With the PE ratio, I will be more inclined if the ratio is around 10 or 20. If the PE ratio is 10, that means it takes 10 years for you to recoup the money that you invest in. It takes 10 years for the company to earn enough income to essentially pay you back, because the price of the shares that you pay for is 10 times the annual earnings of the company. But PE ratio is a relative number, and I really should be comparing that with other companies in the same industry. The PE ratio of a technological company is usually much higher than the PE ratio of a supermarket. But if the PE ratio is around 10, and I know a bit about the company, sometimes I just look at the chart because I'm too lazy and I buy the stock without doing any other research. And once again, this is why you shouldn't trust a guy on YouTube. Anyway, if you are on the desktop version of CommSec, you can also see the PE growth. This is the PE ratio divided by the earnings growth rate. If the PE ratio is 10, that is the company takes 10 years to give you back what you paid for the stock, and the earnings per share growth rate is 10% per annum, the PE growth ratio is going to be 10 divided by 10%. Equals 1. So the PE growth ratio will be 1. If you look at CommSec, CommSec says that if the PE growth ratio is 1, it indicates that the price of the share represents fair value of the company. So let's look at the numbers for Temple Webster. This video was filmed on the 15th of October, and at this time the PE ratio was around 100, and in my opinion that is really massive. I mean, there are companies with 1000 PE ratios, but Temple Webster Group is a friggin' furniture store. It's not a tech company. They sell furniture. There's nothing too fancy about them. If you look at Harvey Norman, their PE ratio is like 11. This means it takes Harvey Norman only 11 years to pay you back. But Temple Webster, it will take them 100 years to pay you back the money that you invest in. But hang on, did I say there is something called PE growth ratio? For Temple Webster, the PE growth ratio is, on CommSec anyway, it's 0.03. That's way under 1, which is usually the fair value. So, does it mean it's very, very cheap? Well, the problem with PE growth ratio is that you don't really know how they determine the growth rate of the company. You don't know on what basis they come up with the growth rate. So usually this is the projected growth rate over the next 5 years. And the projection is done by the analysts who cover the stock. For the PE growth ratio to be 0.03 for Temple and Webster, when the PE ratio is 100, that means the growth rate must be something like 3000% every year. Because if you divide 100 PE ratio by 3000%, you get 0.03. So the analysts covering the stock have assumed that Temple & Webster will be growing at a rate of 3000% per annum. That's 30 times the current earnings for the next 5 years or so. This is another problem of only looking at ratios without understanding the business. Sometimes it's possible that the company has not been making profits. So maybe it had $1 profit last year, as in literally $1. If this year it makes even a $30 profit, the profit has already gone up by 3000%. Next year the profit only need to be $900 for them to achieve another 3000% growth. That's still small, right? I mean, your salary may even be bigger than $900 per week. So surely a big company can make $900 per year, right? So in other words, it is quite possible for Temple & Webster to grow their earnings by 3000% per annum if they start off with $1 profit per year. But the question is, can they grow by 3000% per annum for the next 10 years? I don't think that's realistic. Now, what I have mentioned before are essentially the lazy way of researching a company. So far, I don't even know much about what this company does. I merely look at the numbers on CommSec. Because if I want to know more, I need to read a bunch of stuff. I need to go to Google, go to share trading forums like Hot Copper, watch YouTube, read the financial reports, read the investor presentations. I then need to compare this information with that of other companies in the same industry. Because if you only read information about this company, you don't know what's the normal thing that happens in the industry. So you cannot really compare the numbers. Different industries have very different numbers and very different benchmarks. If I do all of these, it will take me a few hours or a few days. It's a bit too much work for me. But anyway, I'll try to do that today. The first thing I want to do is to understand what this company does. My friend told me that this is a furniture company. Now, after watching some YouTube videos and of course reading the investor presentation, I found out that they do dropshipping. So they don't keep much inventory in their warehouse. At the end of the financial year 2020, they had $6.6 million worth of inventories, and during the year, they sold $176 million worth of furniture, which you can see on the screen here. So that means they only held around 2 weeks worth of inventory at the end of the financial year. For a furniture store, I think this is very small, but again, I don't know too much about the furniture industry, so for you to really know whether this is a lot of inventory or not, you really want to look up the financial statements of other companies who also sells furniture, maybe even companies that sells furniture online so that you can compare. Now in normal times, I think dropshipping is good, but I don't think it is a good idea during the coronavirus pandemic. My dad works for a furniture store, and he told me that some items take 2 or 3 months to arrive from their supplier. I think Temple Webster Group has been a little bit lucky so far. They haven't experienced too much issue with their supply chain. But the coronavirus lockdown is unpredictable, as you know. If suddenly the country or the city where the supplier operates goes into lockdown, Temple & Webster will be screwed because they only hold 2 weeks worth of inventory. Customers may not get their order for another 3 months and they will start leaving. And trust me, they will leave quickly. Sometimes I do want to take a bit of a gamble because who knows, maybe there's no lockdown, or maybe Temple & Webster is so good that they have 10 different suppliers making identical products in 10 different countries. But if I was to take a gamble, I want to have a bit of a backup plan, a bit of an exit strategy. If I go back to the CommSec screen, I see that the market capitalization of Temple & Webster is around $1.6 billion. Their net asset is around $30 million on the investor presentation slide. This was as of 30 June 2020. So that is a price to book ratio of around 50. By the way, this is also on the desktop version of the CommSec platform, but sometimes I like to double check just in case, because sometimes you don't really know where CommSec got the number from. Is it from the 2020 financial report or maybe from the 2019 financial report? A price to book ratio of 50 means I am paying 50 times what the company is worth according to accounting standards, which should be more or less what the company is worth, assuming there's no further growth in the income. Do I really want to pay 50 times? I don't think so. Now, even if there is no lockdown, I do think that this online shopping trend is temporary. People like to see what they buy, especially if they buy furniture. They want to, touch and feel what they will be sitting on 12 hours a day, right? Sure, Temple & Webster has seen some repeat customers. If you watch some other YouTube videos, you will see that they have an about equal split of new and repeat customers. You can see that on their recent investor presentation. This means people do like Temple & Webster and they do come back. But the number of customers spiked after the pandemic started, and that's because people need to work from home and they need to buy furniture. Also, they did double their advertising budget in 2020. You can see that on the profit and loss statement. Over the very long term, we need to work in offices. That's why we haven't been working from home over the last 100 years, because we know that we are more productive when we are in the office. So for the next 5 or 10 years, we may work from home, but after that, we will eventually return to offices. I'm also not convinced that Australians still need to buy home office furniture right now. It's been over 6 months since we started lockdown, and I think the majority of Australians have already got a spanking brand new office furniture by now. At the moment, we have things really easy. There's home loan deferral, there's JobKeeper, there's Job Seeker. But next year this may stop. If there are no more lifelines being thrown at Australians, they will prioritize their food and groceries first and stop buying furniture. So while I think Temple & Webster has at least another 6 months to grow, I'm not too confident about their outlook next year. You may be wondering what's been so good about Temple & Webster's financial performance and why at the moment it's trading at 100 times its earnings, and why the chart looks like this. Well, in 2020, its sales revenue was almost double the previous year. Its gross margin was about the same, so the gross profit almost doubled. The net profit, however, was almost 4 times the previous year, primarily due to them keeping a tight control on fixed costs, which by the way seems to be wages. Because if you compare this page here and this page here, and you look at the commentary on the previous page again, you don't really see anything else apart from wages. A lot of the times, wages are variable costs. The more you sell your stuff, the more your employees need to be paid, the more employees you need. But sometimes you only need one manager to manage a particular department, so the wages of the manager can be a fixed cost. That's until the department becomes so big that you need another manager. I'm a little bit skeptical about how $14.8 million in wages can be a fixed cost, when the variable cost is only $5.9 million. Temple & Webster has put down $5.9 million under the heading of customer service and merchant fees. which is listed on this line item on the other page, customer service staff and merchant fees. I'm guessing that the fixed wages are for the managers and for the administrative staff members, but nothing is truly fixed. Fixed cost just means the cost increases in blocks. It stays the same until you reach a certain production level, and then it will suddenly double when you need to get yourself to the next bracket of production level. So at the moment, it's possible that Temple & Webster hasn't had to employ more managers, more admin staff, but if they keep doubling their revenue every year, at some point, they will need to get more staff. So I don't think they can keep quadrupling their net profit when their revenue is only double. If you're still here with me, you are awesome. Please do remember to give me a thumbs up so that YouTube shows my video to more and more people. Some of the things that I often do when I'm a little bit lazy is to look at the Asx announcement of the company. This is very quick to do. I only need to go to the announcement section on the CommSec trading platform, and then I can filter it to show 2 years worth of data. When I browsed through this, I found out that recently in July, they raised $40 million worth of capital at $5.70 per share. A company usually raises capital on the stock market if they either need money and cannot get a loan, or if they think that the market price of their share is really good at the moment. The company wants to raise capital when the share price is high because they issue capital. They are giving away a piece of ownership in the company. They are basically selling their company, and obviously they want to sell their company at the highest price possible. Temple & Webster had around $38 million in cash before the capital raising, and the proceeds of the capital raising will be used to provide them with financial flexibility to pursue strategic growth initiatives, taking advantage of the significant structural shift towards online shopping, including the enhancement of the company's digital platform and further strengthening of the product and service offering. So I think they raise capital just in case they spot a growth opportunity and just in case they need money. So my interpretation of this event is that they must have believed that their company, their share price is worth $5.70 or less as of July this year. And then in August, the CEO sold around $25 million worth of shares for around $9 each. On this screen here, you will see the Asx announcement. This is the change in director's interest notice. You can see the number of shares and the consideration, which is the money received for the shares. And with this information, you can work out that the CEO sold the shares for around $9 each. They also released another announcement to provide background. It seems that the CEO sold his shares to meet his tax obligation arising as a result of the release of a holding lock. A lot of CEOs get paid in shares. They have a share compensation package. Instead of getting paid purely in cash salary, they also get paid in the form of shares of the company they run. And normally they cannot sell the shares immediately. They have to wait until they achieve certain milestones or until a certain time period has elapsed. Sure, the CEO actually needed the money to pay taxes, but this announcement does not tell me exactly when the taxes need to be paid and when the shares were released from the holding lock. If the shares were only released today, the taxes only need to be paid next year when the tax return gets done. So that means the CEO probably thought that $9 per share is overvalued. On Google, I found out that he has been doing this a few times in the past. He has been selling shares for a similar reason, which is to meet his tax obligation as a result of the release of a holding lock restriction. So I am not too worried about the CEO selling his shares at $9. But I am still a bit skeptical about why the company did a capital raising at $5.70 in July when they were not in the financial difficulty. My gut feeling tells me that they valued their own shares at $5.50. So with everything said, I personally wouldn't be investing into Temple & Webster right now. The main reason is the risk of a lockdown due to the pandemic. If there is a lockdown, then the supply chain will be disrupted. Customers will not receive their order in time and they will start leaving in droves. Secondly, I don't believe Australians will keep buying furniture online. They will probably do that until next year, but then they will reduce their spending when there's no more mortgage deferral, no more job keeper and job seeker. And then maybe 2 or 3 years from now, they will start hitting the bricks and mortar shops again, because furniture is a lot nicer when you can physically touch and feel it in person. When I'm paying 100 times the company earnings, and when the CEO recently sold his shares and the company did a capital raising, I really want to make sure that the company will keep doubling its revenue and earnings for the next 3 to 5 years. In other words, I want the growth rate to be 100% for the next 3 to 5 years, so that my PE growth ratio becomes around 1, based on my own conservative projection of the growth rate. And because I'm not very sure at this stage whether this is the case or not, I will not be buying today, and I would rather choose another company. If you learned something from it today, please do remember to hit the like button. I upload a video on a particular stock every Sunday. If you do want to see me analyzing another stock later on, please do come back next Sunday. I also make a bunch of other videos on personal finance, investing, and how to become a millionaire. So please do subscribe to my channel for more content about money. But please remember, do not trust a guy on YouTube. There is a reason why financial advisor charges you money, because the good stuff does not come for free.